Hello, everybody. Today we're going to talk about a new company. But first, before we get into the company, just reiterate the valuation of stocks. Stock's current price reflects all available knowledge and prices and future prospects. Price is a function of future earnings and cash flow coupled with the current income, which is dividends, and a multiple being paid for those earnings, which is valuation. Fundamentals change over time. Most stock movements in the short term reflect a change in multiple based on sentiment, positioning, events, and news. Valuation in the long run, 5 to 10 years, is the biggest driver of excess return. So today we're going to talk about Verizon. Verizon is the second largest wireless provider in the United States. They have two other main competitors, which are AT&T and T-Mobile. The most important things for consumers as they look to their wireless providers, one, the reliability of the network, and two, price. For wireless carriers, revenues are very, very stable, regardless of what the economy does. You don't have to do much, but other than just go outside or go to a restaurant, go to a park, go any place, you can always see somebody with their face in their phone. Probably the last thing that they'll give up in a down economy. Now, the one thing with wireless providers is costs can be very, very expensive. To one, retain those customers so they don't switch to a different carrier, and two, to invest in the network to make sure that it's keeping up and the speed is there for their customers. So let's talk a little bit about Verizon financials. So here you can see, again, the stability of the revenue. So you're not going to get a ton of growth because most people in the United States already have a cell phone. And so you can see here, we'll just focus on the revenue number. You can see that it doesn't change very much. It was up a little bit, down a little bit, up a little bit, up a little bit, down a little bit, up a little bit, but it doesn't really change much from year to year, which again, that's the stability. That's something that you look at and say, okay, this is very, very stable. And you can see with earnings as well, they've been fairly consistent. You're going to have a slight drop this year, maybe a little bit more next year, but still fairly consistent. And then at the bottom here, one of the things we talked about was the amount of expenses that you have, capital expenditures, to make sure that your network is keeping up. And as you can see, that number went up pretty significantly in 2021 and 2022. And then it's actually expected to drop back down. So you have 20 billion, 23 billion, down to 19, down to 17. And part of the reason for that is the build out of the 5G networks, which the majority of that has already been done. And so now that that spend has been completed, you should actually get a few good years before the next iteration of the networks comes into play. Next, we have, let's take a look at debt, because I think this is an important part of what is going on with Verizon. Because of the large amount of capital expenditures and the stability of the earnings and revenue, companies like this can take on quite a bit of debt. And so with interest rates going much higher, a lot of companies that have debt are being punished pretty severely. So one of the things that is considered is, while they're paying a pretty high dividend, is the debt that they took on to build out 5G, is that going to cause a dividend cut? So one of the things to look at, and this is just a quick financials on how much debt they have, and you can see this is the total amount of debt. So it's consistent, 117 billion, 113, and then it starts to ramp up, and especially in 2019, 20, and 2021, and now it's starting to level off in 22. And again, that is from the 5G build out. Now, it's one thing to have a significant amount of debt, but how do you cover that with your earnings? And that's the thing I think really is important. So right here, you can see it's EBITDA, which is basically it's cash flow, it's operating cash flow. It's another way to look at it. And it's without taking certain things into consideration, it looks at the earnings ability of a particular company. And then it's the interest expense. So how much are you paying for your debt? That's where businesses get in trouble, when their interest expense gets too high and they struggle in the business. And you can see this is actually covered pretty significantly for the last several years. and it's actually coming on the high end, uh, especially in 21 and 22. So even though debt went up, they're covering it by over 15 times and 14 and a half times, which is up from 9 and 8 times just back in 2017 and 18. So they're covering this debt pretty significantly. And even though they're going to have to issue new debt in the future at potentially higher rates, they have a pretty big buffer to be able to handle that. And that's important. And the other thing to look at is, even just from a cash perspective. So it's not only interest expense, but the cash interest that you're paid. They're still covering that pretty significantly at 15 times. So even though interest rates are going up and it may hurt them a little bit, it's not going to be the terrible situation that the stock price is reflecting right now. So the next thing you want to look at is cash flow. So, again, if in a high debt business, cash is king. In fact, in any business, cash is king. There's a lot of things you can do with accounting, but you can't fake cash. It's one thing you can't do. You can't fake cash. And so what's interesting is if you just take a look at it, and I'm not going to go through all of this, but again, here's that EBITDA, which shows, basically the amount of cash that they have and they're generating. And you can see that number has gone up into, around the $50 billion range. What's interesting about that is they're paying about $10 billion in dividends. So they're covering with their cash flow, they're covering that dividend by 5 times. They would have to have something catastrophic to happen in order to really have an issue with their dividend. So another thing to look at here is the free cash flow, which again, this is free cash this is free cash after their capital expenditures. So yes, in a high expenditure business, some of that cash is going to be used to reinvest in the business. And you could see that even without that, that number has come down a little bit the last couple of years, but fairly consistent, 17 billion, 23 billion, 19 billion, 14 billion. It's actually expected to go up again a little bit next year. So that's a pretty significant number. And the other part, and I think this is very, very important, when you look at the cash flow generated by the business relative to net income, a higher number is better, meaning that business. So net income, again, like I said, there's a lot of things you can do with accounting to maybe make your net income look better. There's not much you can do with cash flow to make that look better. So when cash flow is better than net income, you're going to have a number higher than 1. And that's been, it dipped in 2017 below 1, but it's been fairly consistent. And, at 1.7 times cash flow to net income, that's a pretty strong number to look at the cash flow of this business. And again, these are cash flow numbers in a stock that's been pretty much straight down for years and has been, and I put in quotations here, struggles. It's been struggling, and yet it still has been generating a significant amount of cash flow. So the next thing, and talked about this before, which is the multiple. What is the multiple that people are going to pay on those earnings? And right now, so you have the white line, which is the multiple, and you can see there's periods where it drops significantly, but in the past it spiked and dropped relatively quickly. And then the blue line is its actual earnings per share. So you can see there was a drop, back in the mid 90s. That was probably something, it was very quick. That was probably something specific. It happened again in 2000, and looks like this was 2013. That was probably something specific. This is actually the around the recession of 2001, 2002. So there was times where the earnings dropped, but it bounced right back up. And otherwise, it's been fairly consistent around these levels for a number of years. And actually, here's a spike. This was, probably some other instance where there was something happened that was like a one-time off item. Now, what's interesting is if you look at that multiple during those periods where it dropped, yes, the multiple dropped significantly. And again, here the multiple dropped significantly again, dropped as earnings dropped. Right now, we've got earnings that are staying high and a multiple that has gone now to record lows of the last 40 years. So it's not really matching up with the actual performance of the company, even though the narrative is, oh, well, Verizon is struggling, Verizon is struggling. So what's interesting is if you take, obviously there's highs, there's lows, but if you take the average, it's going to be somewhere here around that 13 13 maybe to 14 level. That's the average multiple over the last several years. And so again, why is that important? Because long term valuation matters and a reversion to the mean matters. So why do we talk about multiples? Because multiple is a reflection of the psychology of the market. So short term can be 2-3 years. Markets move based on that psychology. They pay a higher multiple or a lower multiple based on the perception of that particular stock. And so that's one way to measure it. Now, another thing is to look at what people are doing in the actual psychology of how they're playing those particular shares. And so what we're going to look at here is a chart that looks at a potential change in the psychology of Verizon. So we have a multiple that's at all-time lows. And how do we look at a change? And one of the things we want to look at is for years, people are saying, well, Verizon is stable. They pay a nice dividend. Okay, they're maybe not growing that much, but it's a good company. It's not going anywhere. And the stock has done nothing but go down for a number of years. So what ends up happening is if you have a company that or a stock that's gone down for a number of years, then eventually you get frustrated. And the psychology is you need to have more buyers or you need to have more sellers. Otherwise, a price will reverse. So how do you look and find that? And one of the things that I like to look at is what's called capitulation or euphoria. So they're inversely related. Euphoria would be when, think about 2021, where people were buying unprofitable tech stocks and they were going up 20, 30% on massive volume just because they announced that they were going to, with just like a little announcement that came out and the stock went up. That's euphoria. Similarly, and what happens is you see spikes in volume. Similarly, you see the same thing, what's called capitulation, which that last person sells and says, you know what? I've held this stock for 5-10 years. It's done nothing for me. The market's gone up. I don't know why I continue to hold it. I need to sell it. I'm just going to sell at all costs. And usually that happens around some type of piece of news. So here we're going to look at the chart of Verizon. And this is just, these are the moving averages, yellow, green, pink. And then the white line is the price of Verizon. So you can see it's gone pretty much straight down over the last year. Now, what's interesting, here's the volume. So it trades about 27 million shares a day. Now, what happened in mid-July where all of a sudden there's a massive spike in volume in mid-July? And you could see the stock price dropped pretty dramatically on that particular day. Now, what happened? That was the announcement that AT&T and Verizon had lead cables buried underneath the ground, and that was going to be a massive issue, and everybody was going to sue them. And so that was like kind of like the last straw for most investors. So you look at this and you say, well, okay, this is the last seller. That is people giving up, saying they're going to sell at all costs. This is more than 5 times. This is more than 5 times the average volume over the last year happened on this one particular day. Now, what's interesting as well, and so this bottom pane looks at relative strength. So it's just it's a relative strength, and basically what it does is this red line, when it goes above the red line, it means it's overbought. When it goes below the green line, it means it's oversold. Doesn't mean you can't get more overbought or more oversold, or the price can't go up and down, but it tends to show just a short-term momentum in the stock. And so what's interesting is you like to look for divergences. And we had a major capitulation here in July. And then the price started to recover, and then it went back to new lows in early October. At the same time, in July, it had a very, very low relative strength reading, extremely oversold. When it hit a new low in price, we had a higher low in relative strength. So what does that mean? It's a lot of different terms. What does that mean? It basically means that here, even though the price hit a new low, on a relative basis, there was less selling at this new low than there was at this one, even though the price dropped. And what's interesting is, and you want to see that get validated, right? And it should validate very, very quickly. So look, we've got a low price on very heavy volume, a lower price on just about average volume. So the selling isn't picking up at a lower price, and then all of a sudden it reverses and reverses in a big way. And now you have an earnings report where the stock price jumps and then it continues to move higher. To me, that is a sign, a potential long-term sign. So we have the fundamentals, but that is a potential long-term sign that the psychology around this stock is changing. And so what does that mean? What does that mean? Where can Verizon prices go? So from a fundamental perspective, you put a slightly below average multiple. So again, we said 13 to 14 was its average. So we're going to say they're going to continue to struggle, and their average multiple is 12 and a half. If you put that on next year's earnings of 4.62, you get a price of 57.75. That's 60% upside to the current price where it is. Additionally, the dividend was recently raised by 2% and is 7.4% on today's price. So you're getting a very, very high current income with also potential upside. So we go back to the charts that after years of holding the stock, and stock investors threw in the towel in July, and now we've started to move higher. And lastly, a lot of bad news is priced into the stock. And so at these levels, it has a nice risk reward. So 30 being the downside, which is where it hit that most recent low in October on that divergent relative strength. And we've got potential upside into the high 50s. So the downside is relatively limited, around 10 to 15%. With a 7.5% dividend, even if it dropped that in 2 years, you would recover all your money with potentially 60% upside from here. So we like the risk reward in Verizon, even though the price has struggled for a while. We do also think that it's changing from a psychology perspective. So thank you very much on Verizon, and we look forward to the next